only one accounting equation in accounting. Only one equation. Unlike mathematics, you have parabola or other things in engineering, but it's only one here. Assets are always equal to your liabilities plus shareholders' equity. Okay, that is the basic definition. Assets will always be equal to your total liabilities, whatever you own to somebody else, or whatever money you have put into your balance sheet. So the balance sheet is made up of three components. One is the asset, one is owner's equity and liabilities. Okay, so this segment, it can be larger for owner's equity or can be larger for liabilities, but assets will always be the same. So what does it tell you? It tells you how you are funding your assets, where the money is coming from to buy the assets. It can come from your own pocket, means owner's equity, or it can be borrowed from outside. It can come from debt, it can be from your suppliers, it can be from anywhere else. So total is liabilities. Okay, so that is the basic definition in accounting, and everything follows it. Okay, sorry. So the extended definition of accounting is, because we have one something called, so here in this balance sheet we are not recording sales or income. So this is something called extended definition. So extended definition is owner's equity can further be divided into your original capital. Your paid in capital means the money that you started the business with, and net income, whatever you have been earning. So if from your income you pay any dividend, means you withdraw money from your business, that is minus, the rest will go back to your owner's equity. Okay, so the owner's equity net income will take care of your revenue, your cost and everything else. So this is how the profit and loss statement and balance sheet are merged, or you can say are matched together. Okay, so balance sheet is the ultimate document. Profit and loss statement is one step prior to balance sheet. To arrive at the balance sheet, you need to make an income statement to see what is your income and expenses and total income. If you have taken money from your income, means the dividends, that also you can minus, and the balance will go to your retained earnings. Okay, clear? So now you can draw the balance sheet. Okay, we will do a bit of exercise. So this is an example of how normally a income statements look like. So normally you have a sales, you have a cost of sales, gross profit, and then gross margin, and then we normally have selling expense and operating income, depreciation, amortization, interest expense, taxable income, then we pay the taxes, then we have a net income and the net income margin. So why do we have this separately? What is the meaning of gross profit?
Overall profit.
Not overall.
It means, let's say, if I buy something for 100 and sell it for 150,
Yes.
gross profit is 50.
So that's gross profit. Before making out any administrative or selling expense.
Net is when you subtract like everything.
Subtract other expenses. So when you are subtracting your selling, so gross, why you want to know gross profit and why you want to know other net profit separately? What is the logic?
And you can tell your operation costs, your overhead.
Operation cost also, and your pricing.
Yes.
Are you pricing your product properly or not? If your net profit is loss, let's say for example, see, pricing is means it depends on your customers also, right? How much your customers are willing to pay. If let's say you buy something at $100 and you are selling it in the market, the price is 120, you cannot charge 130 because your expenses are another 20 to pay the traveling or other selling and the general expenses, right? So you cannot charge customer 130 because your expenses are high. So what do you mean? It means what do you need to do? Either reduce your purchasing price or control your expenses. That's the only way. Selling price will not be able to increase because of the competition, unless you are the only one in the market who is selling. If you are the only one in the market, go ahead and increase the price. But if you have other competitors, you will not be able to increase the price unless you add more value. Maybe you want to add something more, make it more nicer, make it more better, make it more easier for consumer to use, add value, then you can charge more, otherwise you cannot charge, correct? And then the other expenses, to see how much is the percentage of other expenses. So you can compare the businesses, different businesses or different business models with the help of profit and loss statement. How the two different business models are comparing. Somebody may be manufacturing everything by themselves, so they don't need to do a lot of other expenses, right? Maybe they are not, if let's say they are manufacturing themselves, they need to have a factory, they need to have a fixed labor cost, they need to have a lot of land tax or other licenses, or otherwise they can go and buy from the market directly. Then they don't need to have a factory, they don't need to have administration, they don't need to have a lot of staff, so they will save, but the cost of buying will be higher. So you can assume two different businesses which are having two different business models. One is buying directly from the market and selling, no administration, no fixed cost. Another business is doing everything by themselves, buying raw material, making the material, and then selling it, and may also have a marketing expense, right? So there are two different models. So you can compare the profit and loss when you are looking. So their gross profit will be different, and net profit may be different, may not be different, right? Maybe if they say totally they are spending the same money, you are doing everything by yourself, but the profit remains the same. So you can judge which model is better for you and when. Okay, you may be if you are in a trading business, you can be selling branded products or unbranded products. If you're selling branded products, you may not need a lot of marketing, because the marketing is done by a brand. But if you're selling something unbranded, you need marketing, right? A lot of marketing expense. So the segregation between cost of goods sold and the selling and general expenses help you to understand the benefits or the disadvantages of different business models. Okay. Then the other are interest and depreciation. So we call this operating income. Why we don't include interest in operating income? Any idea? What is the meaning of operating income and net income, taxable income? Now a lot of businesses are putting depreciation as selling, general and administration expense. Some business they still separate it up, but that's a different discussion. What I want to put you is operating income. What is the difference and interest expense? Does it make any difference on your business if the money is coming from your pocket or from your father's pocket or from the bank? Does it make any difference on the business performance? No, right? The business will still run as the same. The money where it comes from, it doesn't make any difference. You may have your own money, you may have borrowed money from the bank, you may have borrowed money from your father, which is not interest, right? Or you may have borrowed money from a microfinance company which is charging you like 3%, 4% per month. But the ultimate objective is you are putting the money into the business, and for business performance there is no difference where the money is coming from. The business will run it as it is own, right? Correct. So the operating means how does the business perform. So you may have money on loan, or you may have money of your own on your own. So the operating income will tell you the real business operating performance, not the net income. Net income is only for owners. Operating income is mostly for business. So you may think now, if you are a startup and you have borrowed money from somebody, and somebody else now come and buy your business out. If you base your valuations on net income, because you are running business on the interest, your valuations from your perspective are very low, right? Because you are not operating the business. You are making valuation from your own income point of view. But if somebody else who has his own money, he don't need to pay the interest. For him, the income will be more, correct? So immediately the valuation will jump. Okay, so valuation part is the last class, so we will not go into it now. Okay, this is a part of balance sheet, an example of balance sheet. How does a normal balance sheet looks like? So you can see here you have assets, non-long term assets and long term assets. So long term assets means which one you are going to use for more than 1 year. So all the definition of long term is more than 1 year, and you will see there is something called depreciation here. So depreciation means you are charging the value of assets over the life of your assets. So if let's say you have an asset for 3 years, so for example a laptop, how long it's gonna last for? 3 years, maybe 5 years maximum, right? After that it's become obsolete. So if I spend 1000 now, and I'm not charging to this profit and loss account because I'm putting it in my asset. Whatever I define as an asset, it's not going to be charged into profit and loss statement, not as my expense. But I still pay the money, right? I still need to recover this money in 5 years. So what I'm going to do is I will divide the value of this laptop by 5 in each year, and I will charge one portion to the profit and loss every year. Divide by 5. If life is 5 years, if life is 10 years, divide by 10 and charge every year. So that charge is called depreciation. So why do we charge depreciation? To show the profit in equal terms in real life. So if the value is going to be charged for 10 years, we charge 10 years. If this is going to be used for 5 years, we charge in 5 years, equal installments. And also to keep a reserve. If let's say you are a business and you make $1,000 every year, but you need to pay depreciation, you are not paying depreciation, right? You are just making a charge to the profit and loss. After 5 years, you need to replace the asset. So where are you going to get the money from? If you are the owner and you see the whole profit, you will take everything as a dividend, correct? You will take out the money. Oh, I am earning a lot, so let's take out the money in cash. After 5 years, you have no money left to replace the assets because you already finished. You already spent all your money, right? So to keep a reserve of cash so that you can replace your assets in future. So it's like creating a fund slowly to replace the assets in future. So this is very important for a business which is very heavy on assets. If it's a startup which does not have a lot of assets, it doesn't really matter a lot. But if it's a factory building which is depend on assets, it need to build a reserve slowly so that after a certain point of time, when you need to replace the asset, you have money. If you don't have money, your business will shut down after 10 years, right? Okay. This is another statement. Normally, so here is you have assets, long-term assets. Non-long-term assets means the asset which are going to be finished in less than 1 year. So if something is less than 1 year, cash, is it gonna last for more than 1 year? No, because you need it tomorrow, right, to spend. In receivables, are you going to not collect the money for more than 1 year from your customers? No, you want money immediately, right? Or within 30 days or 45 days, whatever is your credit period. Inventories or your material, you want to sell as soon as possible, right? You are not going to keep that for more than a year. So that is all non-long-term assets. We call them non-long-term because our intention is not to keep for more than 1 year. Our intention is sell it out. If it doesn't sell, it does not change the definition here because it depends on our intention. If our intention is that we don't want to sell the inventory for more than a year, then okay, it's moved to long-term assets because you don't want to sell. Okay, liabilities work the same way. Now long-term means whatever you need to pay after 1 year, and non-current liability means whatever you need to pay within a year. Owner's equity means what money you bring in and whatever profit you have been earning during the life of your business. So the statement of owner's equity show you the reconciliation. What was your equity at the beginning of the year? How much money you earned? how much money you paid in a dividends, and what is the left, what is the balance. Okay, and finally cash flow. So cash flow is another more important document of any business. So what does cash flow does? It has three, as you can see, three segments. One is cash from your operations, cash from investing, and cash from financing. So cash from operations means your business operations, buying, selling, right? So how much money are you able to make from your normal operations? The cash from investing means how you are using the money. Investing normally will be in negative because you always are investing into the business, right? You always buy some new asset, you always buy new equipments to continue your business. So it will tell you where the money is coming from. The financing can be plus, can be minus. It means if you are taking a loan or you are repaying a loan, or you are buying a new equity share, or selling your existing equity shares. So financing means it can be plus or minus. So how does it look like is whatever you have investing. So in this case, you are investing $115,000. So where this $115,000 come from? If business is investing $115,000, where the money is coming from? If you look at the statement, the money come from some money come from operations, right? 33,000, and the balance come from financing. In financing, what did they do? They are acquiring a new loan, right? 105,000, and they repay some short-term loan and dividends, correct? So means this is how they are using. So, but primarily they took a loan to buy a new asset. Some of the money come from their operations. So this statement will give you a snapshot of the company's overall performance in one single page. How much money is it? The company is able to make money or not? Is it how does the company is spending its money? Is it investing enough or not? So what is more important here? Cash from operations. So if we say you have a negative cash from operations, means you are not earning enough. Is it good or bad? It's actually very, very bad. So means if it's minus, what does it mean? You have no money to invest, correct? And where the money come from? Borrowing, right? Otherwise the balance will be zero, and cash cannot be negative, as we said earlier, right? So if you are losing money from your operations, where the money will come from? The money will come from borrowing. So which is not a good idea for a business. You cannot run a business successfully for a very long period of time only with the borrowing, or only by raising the money from investors, correct? So means issuing the share capital. That is not a long-term strategy. So if normally the investor or anybody who is investing the money to the business, they will look at the cash flow statement for last 3 to 5 years and see what is the trend. Is it the company being able to generate cash from operations or not? If company is able to generate the cash from their operations, it's okay. They may invest the money. But if you are not able to generate the cash from your operations, it's going to be very, very difficult to project that the company will survive for another 3 years, 5 years or not. Because whatever money they have been giving, you are losing in operations, right? Okay, so that is cash flow statement. So these are the 4 statements. 3 of them are very important. So what are the important ones now? What are the three financial statements we learned? First is profit and loss statement. So what profit and loss statement tells you? Your income and your expenses. The second is balance sheet. So what does balance sheet tell? Your assets and your liabilities. And the third statement is cash flow. So what does cash flow tell? Where the money is coming from and how you are spending the money. So profit and loss will not be able to tell you where the money is come from. It will just tell you how much did you earn and how you spent. but it doesn't give you the assets, your investment, right? Or where the money is coming from if you are making a loss. Cash flow is telling you both the story. So cash flow, you can say, is a summary of your balance sheet and your profit and loss statement. So if you are not able to get profit and loss statement or the balance sheet, it's okay. So far as you understand the cash flow, that is the main document. You may be making a lot of income. What if you are not collecting it in cash? Maybe you are making a lot of sale. But what if your customers are not paying you? Correct? So what will be happen to your cash from operations? It will be positive or negative?